At some point in time, the generalist investor comes down into the precious metals market, having been attracted by gold's momentum. And then perhaps because of its unit cost, silver takes over the leadership. And when it does, as you know, it's truly, truly, truly dramatic. And although I don't need to make more money, I want to make more money. I really, truly enjoy the game. I'm 72 years old, and I want to experience that sort of quantum escalation at least one more time in my career, and silver gives it to me.
Welcome to our deep dive into the latest insights from legendary investor Rick Rule. In this video, we'll break down his recent interview, covering his perspectives on precious metals, the future of the dollar, and exciting new ventures. This content is for anyone interested in understanding market trends, particularly in natural resources and precious metals. You'll gain valuable insights from a seasoned expert, helping you navigate the complexities of today's financial landscape and potentially identify new investment opportunities. Rule believes we are entering a precious metals bull market reminiscent of the 1970s. He highlights how generalist investors are typically drawn to gold's momentum first, but eventually, silver takes the lead due to its lower unit cost and dramatic potential for escalation. This historical parallel sets the stage for his bullish outlook. Gold has shown impressive performance, up 27% in 2024 and another 26% so far in 2025, reaching new highs. Rule admits he's not surprised by this, as he felt gold's previous muted response to purchasing power concerns was unexpected.
Whenever I criticize speculators at a conference like this, if Bonnie, my wife, is present, she starts laughing and she says, by the way, all the money that Rick invests conservatively, he made speculating wildly. So, yes, I have a fondness for it. I've participated in 3 precious metals bull markets in my life. This will be the 4th. And at some point in time, and I'm never smart enough to say why, you probably are actually, given your competence in technical analysis. When I came into business, I'm older than you, as you know, when I came into business in the 1970s, I witnessed an amazing silver market. The stuff went from $1.30 in 1970 to $50 in 1981. One stock that I was aware of, but I was too dumb and too poor to buy it, was Coeur d'Alene. It went from 10 cents, this is not a typo, 10 cents in 1970 to $65 in 1981, and that stuck, you know, that stuck in a young man's mind. But I didn't participate. But as I think you know, in the later part of the 80s, the early part of the 90s, which was a spectacular silver market that people forget, I was involved in Silver Standard, which we took from 72-cent financing with a full warrant, thank you, to 6 years later, $45. And Pan American Silver from 50 cents, Ross Beatty was too cheap to give me a warrant, to $45. Those 2 moves, from below $1 to $45 in 6 years, stuck with me and have stuck with me forever. We are, I believe, coming into a precious metals bull market that will resemble the best of the prior markets, and if past is prologue, that same performance. I'm not saying $1.30 to $50, don't get me wrong, but that same sort of relative outperformance, silver to gold, and then silver stocks to silver, I think we'll see in this market, and I'd like to play it.
Rick Rule holds a special place in his heart for silver, confessing that much of his conservative investment capital was made through wild speculation in the past. He anticipates silver will once again outshine gold in the upcoming bull market, offering dramatic returns when generalist investors enter the precious metal space. He describes silver's past performance as truly, truly, truly dramatic, recalling the 1970s when silver went from $1.30 to $50, and stocks like Coeur d'Alene saw incredible surges. This deep historical experience fuels his desire to experience another quantum escalation in his career, seeing silver as the primary vehicle for this. Rule recounts his personal involvement in spectacular silver markets in the late 80s and early 90s, where stocks like Silver Standard and Pan American Silver went from under $1 to $45. He believes similar relative outperformance of silver to gold and silver stocks to silver will characterize the current bull market.
So you made the comment that you think we're heading into a very important precious metals bull market. So I'm going to pin you down, since we just went from, 1,800 to 3,300. what do you see that excites you about the next 5 years as opposed to the past 3?
You got to give me the next 10, not 5.
Okay.
I believe that the analog to the deterioration of the purchasing power of the U.S. dollar that we're going to experience is the 1970s. In the 1970s, according to the Office of Management Budget, the U.S. dollar lost 75% of its purchasing power. This is not some old fat libertarian, Rick Rule, saying this. This is the office, the Congressional Budget Office. I believe that because of the accumulated debt and deficit, particularly off-balance sheet debt, entitlements, and the unfunded entitlement liabilities, that the purchasing power of the U.S. dollar over the next 10 years is going to decline by 75% again. I don't know how it'll be reflected in the gold price, but the easiest thing for me to say arithmetically is that the increase in the gold price will mirror the deterioration of the purchasing power of the U.S. dollar. If that is more or less right, then the gold price goes up fourfold from here. People say to me, Rick, like, give your head a shake. Gold has already gone. It's already up 40%. If the analog is the decade of the 70s, let's assume that the move in gold price from $35 to $100 was a dead cat bounce off the restriction of the gold price. And let's say that the move in the gold price above 550 to 850 was morons piling on. That move from 100 to 600, six-fold move, is a pretty good move. And if the cause of it is the perception of the deterioration in the purchasing power of the U.S. dollar, I think it's absolutely right to assume that the increase in the gold price, the increase in the nominal gold price, could reflect the deterioration in the purchasing power of the U.S. dollar.
So do you think that the scenario for the U.S. dollar in the 70s was mostly motivated by inflation, or?
It was motivated by a negative real interest rate.
Okay.
We fought, well, you didn't, well, you were alive then. We fought the war in Vietnam, which we lost. And we fought the war on poverty, which we lost. And the highest marginal tax rate in the United States then, before weird deductions, was 80%, so we couldn't raise taxes. We had to deal with these social obligations. We did it not by changing the nominal value of our obligations, but really by changing the purchasing power of the dollar. The second thing that happened is that the way that the fear of inflation was expressed in the market, or put differently, the experience that consumers had with inflation juxtaposed to the rate that they got on their savings, meant that interest rates were sharply negative. We had a 10% measured rate of inflation. We measured it, of course, differently then. And people were getting paid 5.5% on their savings accounts. Well, that was reflected pretty clearly by a change in asset allocation from cash and cash equivalents or long-term bonds to gold. We have a circumstance today, Trey, where if your listeners believe in the CPI, they're pretty sanguine. You get a 4.5% yield in the U.S. 10-year Treasury. In a currency where your purchasing power is deteriorating by 2.5%, you're getting a 200 basis point real yield. I believe that's ridiculous. The CPI is not a good measure of the deterioration of the purchasing power of your savings. For one thing, the CPI doesn't include tax. Do you pay tax, Trey?
A little bit.
Yeah. If you look back at the basket of goods and services that the Reich family consumes, say, I don't want to test your memory and go too far back, but 2020 to today, gasoline prices, up 2.5% compounded? Hardly. Mortgage rates, doubled. Groceries are a political issue, up 60%. And they're telling you that the deterioration of the purchasing power of the U.S. dollar is happening at the rate of 2.5% a year? I mean, what they're smoking is not legal to transport state to state to state. I believe
my favorite CPI stat is they measure the cost of health insurance. Have you heard this one?
Yeah, it's down
by the retained earnings of the insurance companies. That's literally, when you look it up, it says we calculate the cost of health insurance by measuring the retained earnings of the insurance companies, and you're like,
These guys should sell penny stocks.
And I don't know if you know this, but the cost of health insurance is actually declining, over the last several years, according to that metric, to their metric, which I think is pretty incredible.
Yeah, let's compound the losses and call this again in the CPI.
A key point of contention for Rule is the Consumer Price Index, or CPI, as a true measure of inflation. He argues that the CPI does not accurately reflect the deterioration of purchasing power, citing examples like rising gasoline, mortgage rates, and grocery costs. He humorously points out the discrepancies, suggesting a much higher real inflation rate than reported. Rule emphasizes his concern about the absolute deterioration of the U.S. dollar's purchasing power, not just its relative strength against other currencies. While he believes the dollar will remain the world's reserve currency for his lifetime, he foresees a reduction in its hegemony due to politicization and debasement of U.S. treasuries.
I was surprised that gold hadn't moved further, faster, earlier. My belief, and Trey, you and I have discussed this over dinner, my belief is that gold does well when people are concerned about the maintenance of their purchasing power in U.S. dollars. I've been concerned about that for a very long time. The arithmetic that concerns me is not expressed by the CPI, which I don't think is a good index. So I've been surprised by the muted response of gold hitherto. I didn't know, as you know, because we talked about it, when gold was going to move. But it seemed to me like an inevitability. As you and I both have talked about, I have a flaw in that I often confuse the words imminent with inevitable. But no, I haven't been surprised at all.
And I know that you're fairly focused on debt and the macro situation. Do you think that the dollar standard system has already begun evolution to a new global monetary reserve, or is that overstating it?
I think it's way overstated. When I talk about the deterioration of purchasing power of the gold, I'm talking about in an absolute sense, not in a relative sense. I think relative to other currencies, gold will do well. Franz Pick said there's a lot of ruin left in a country that's great. Ruefully, I agree with that. I believe that gold will be the world's reserve currency for the balance of my life. For the record, I'm a healthy 72-year-old. But I think its hegemony will reduce. When I look at
the dollar's hegemony.
Yes, it'll be reduced. I think the U.S. government is doing their best to destroy the U.S. Treasury as a savings instrument, politicizing it, debasing it. But what are the alternatives? Our friend, Doug Casey, once said the dollar is an I owe you nothing, but the euro is a who owes you nothing. And I mean, the other analogy is the prettiest mare at the slaughterhouse. I'm not concerned about the dollar relative to other mediums of exchange. I'm worried about the dollar as a storehouse of my own wealth. I personally, Trey, I'm telling this to your audience, you know this, I personally save in gold. I personally maintain liquidity in dollars. Those are two different statements.
Very similar to Grant Williams. He was saying the same thing when we discussed this in terms of, is there a target where you would sell your gold? And his answer was, when there's something I want to buy with it, and I think it's a good value, which is an interesting and simple.
That's precisely what happened to me in 2010. Now, I didn't catch the top. I never do. But there were other circumstances where stuff appeared to be much cheaper. The consequence of that is that I made the swap. I do consider gold to be a form of liquidity because I've proven to myself over 40 years that when the time comes, I'm not psychologically indisposed to selling it. One of the things I do, which I think your audience might find of interest, is that beginning in the year 2000, that was a momentous time, and I had a discussion with myself. Where did I want to go? What did I want to do? One of the things that I began to do was to keep an informal alternative ledger in gold. My net worth, my income, my expenses in gold, rather than in the U.S. dollar. And for that part of my ledger, when I look at what things cost today, I wish I'd been all in gold. Some stuff like rooms at this hotel, or a Big Mac, or a car, are really cheap. If you measure them in dollars, they're anything but cheap. But understanding that the dollar-gold exchange ratio was $250 to an ounce of gold at that point in time, if you equalize the numerator and the denominator, if you measure your savings in gold, you're struck by the deterioration of the purchasing power of the U.S. dollar, and you're surprised by the steady reduction in the actual price of many goods and services on a global basis if you're valuing them in a constant. It's a really interesting consciousness-raising exercise.
He projects a 75% decline in the dollar's purchasing power over the next decade, akin to the 1970s, due to accumulated debt and unfunded liabilities. This dramatic forecast suggests a potential fourfold increase in the gold price if it mirrors this decline, challenging those who think gold has already peaked. Rule distinguishes between gold as a savings instrument and liquidity. He personally saves in physical gold to maintain purchasing power, while keeping liquidity in dollars. He even maintains an informal ledger in gold, noting how many goods and services have become cheaper when valued in gold since 2000. Rule categorizes investments into three distinct buckets: insurance, investment, and speculation. Gold serves as insurance and savings, not a money-making vehicle. Gold stocks are investments, a way to increase one's gold holdings, while junior speculations are a different, more hands-on game. He highlights that gold itself requires no work, akin to a life insurance policy. Gold stocks, however, demand more effort and understanding of the business. His true competitive edge lies in speculating in junior mining companies, a craft honed over 50 years of mistakes and dedicated work.
Gold for me is insurance and savings. Gold stocks are investments. I don't own gold to make money. I own gold to maintain liquidity and maintain my purchasing power. I'm good at buying gold stocks. I've worked at it for 50 years. It's my craft. That's different. Owning gold stocks is one of the ways that I increase my store of gold. But they're different businesses. Gold doesn't require any work. Just like a life insurance policy doesn't require any work other than paying the premiums. So I regard them as very, very, very different asset classes. In a different part of my life, in addition to being an investor in gold mining companies, I'm a speculator in the juniors. And relative to other people, I'm actually a better speculator than I am an investor. I'm willing to do the work. I have 50 years of mistakes, but there are three different buckets: insurance, investment, speculation.
And that speculation bucket, I think you would always recommend people have a very, very long time frame, correct?
Yes, and be willing to do the work. The more speculative the entity, the more psychological tolerance that you have to have for perturbation, and the more willingness you have to work. I have, as I think you know, Trey, graded tens of thousands of investor portfolios for free over the years. I ask people to submit them to me. I grade them for free. I've taught a lot and I've learned a lot. And I ask investors to limit the number of speculations that they have in their portfolio to the number of hours per month they're willing to work on their speculations. Not got a hunch, bet a bunch. Read the quarterly filing statements, read the proxy statement, read the resource statement, read the insider filing statement. If you are willing to work 10 hours a month, by 10 hours a month, by the way, I don't necessarily just mean listening to podcasts, but rather reading filing statements, doing something like that, then you could own 10 stocks. But many of the portfolios that I've graded have had 65 or 70 stocks, and some of the stocks are unpronounceable to the holders. That's not good.
For speculative investments, Rule advises investors to limit the number of holdings to the number of hours they're willing to work on due diligence each month. This means reading quarterly filings, proxy statements, and resource reports, rather than just acting on a hunch. He's graded thousands of portfolios and seen the consequences of insufficient work. If you found this information valuable, please hit that like button, share this video with fellow investors who might benefit, and subscribe to our channel for more in-depth analyses and market insights. We eagerly await your comments below. Let us know your thoughts and what topics you'd love for us to explore next.